In this session, we'll try to focus on how do we value the bonds with embedded options into it. So whenever I am talking about embedded option, the bond containing either a call option or a put option. So how do I get into the valuation of these embedded options, or probably a similar kind of a feature is even associated with a convertible bond. So all these things come under the category of those bonds which have embedded options in them. And what is understood is, for valuing these kind of bonds with embedded options, the most common mechanism that is being used is a binomial tree kind of an approach. So either for valuing these bonds or even for finding out, we will look at finding out the option adjusted spread. Even for this particular process, we can use the binomial tree kind of a model. We can even find out what should be the worth of the call option, or what should be the premium of the call option or the put option that is embedded. And probably on a similar terms of call and put, there is something called warranty associated with a kind of a convertible bond. So how do I value these kind of various entities that are present in the bond? And finally, how do I assess the risk? How do I do the risk assessment with respect to these bonds with embedded options, which can be tried out using the computations of duration and convexity associated with these bonds with embedded options. So all this entire thing requires us to understand the basic concept of valuation, wherein we are talking, especially if I deal with relative valuation kind of a model. We all know that we compare, especially with respect to these bonds, we compare the spread that is present on our bond. What is the way we look at the spread? What is the yield that my current bond right now is giving? So yield on the bond minus the yield on whatever I am taking as a benchmark. In fact, I can set the benchmark as any of the securities. Either I can take the industry as the benchmark for this particular bond, right? Whatever is the average yield which the competitors are typically offering. I can pool a set of bonds which are based on one single industry or something, and based on that I can set as the benchmark, or I can directly take a treasury securities with similar kind of features as this bond. I can take the treasury securities as a benchmark, or probably, as I said, I can take the industry or the sector average as the benchmark, or probably I can look at a specific issuer also as the benchmark. All the bonds that are issued by company X, those things also can be taken as a benchmark. So whatever I am taking as a benchmark, and of course depending on what I have taken as a benchmark, the spread could change, because it's a difference between the yield of the bond which is of interest to us and the yield on the benchmark security or benchmark portfolio which I have taken. So whenever we are talking about the relative valuation here, I compare the spread with, this is the actual spread. I compare the actual spread with the required spread. So I am expecting that this particular bond should have a spread of this much, but in reality today the spread is this much. So I am comparing, whenever we are talking about the valuation part, I am looking at the actual spread versus what is the required kind of a spread. So if at all we are seeing that the actual spread is greater than the required spread, we say that the bond is more or less undervalued. It is available for a cheaper value. So it's better to go for a buy on those kind of bonds. Wherever you see that the actual spread is much lesser than the required spread, we say that they are overvalued and go for a sell decision. And probably where the actual spread is equal to required spread, I say that they are fairly valued and probably no such decision can be gone forward. So that is the typical way we look at the valuation process. And as I have mentioned, for valuing the bond with embedded options, we should look at a binomial tree kind of a model, right? A Black-Scholes option pricing model may not be that appropriate for interest oriented securities, because the one of the major assumptions of a Black-Scholes formula model for option pricing is it assumes that the required rate of return or the risk-free rate of return R is constant throughout the period, whereas the typical underlying entity for various fixed income securities or fixed income derivatives is the interest rate itself. So we cannot use a Black-Scholes kind of a model for the fixed income securities dealing with the interest rate fluctuations. So we will go ahead using a binomial tree model. So the first step in a binomial tree model is building of the interest rate tree. So whenever we talk about an interest rate tree, I look at, okay, the 1 year interest rate as of today, spot rate, as of 1 year spot rate as of today. Then after 1 year, there is a possibility that the spot rate can be this much or this much with some kind of probabilities. Similarly, if the spot rate comes here after 1 year, then after 2 years the spot rate can touch either this or this with some probabilities. Similarly, if after 1 year the spot rate had come here, probably the spot rate can go to. So this is a kind of a tree that we are trying to build with filling the interest rates at each of the period. What could be a 1 year interest rate or 1 period interest rate at each of these points, and probably with what probabilities we can expect that this particular interest rate can come out at each of these points. And at each of the points the interest rate probabilities could be same or different, and similarly the rates also could be same as well as different. This kind of a tree, of course, very complicated to make, very lot of factors need to be considered while preparing this particular tree. But in this particular tree, where we are assuming two different possibilities at any point in time for the next period, we are assuming two different possibilities of interest rates with different probabilities that are assigned to each one of them, and that is what is resulting in one period, depending on how many periods which we are using. This is one period, this is one more period. So we have first predicted the interest rates for one period and from there for one more period. So this forms a 2-period binomial tree model. Otherwise I can create 1 period or even n period kind of a binomial tree model. And here what we are talking of is the interest rate as of this particular period, right? The interest rate during this entire period, or probably today I am taking the interest rate here, mean it's a 1 period forward rate. When I am taking an interest rate here for the security which would be maturing at this point, I am assuming this is the interest rate, which means whatever the cash flows that are coming here, I discount it with this interest rate. In general also, the interest rate that is determined at the beginning of the period, we make the payment at the end of the period. So whatever the cash flow that is corresponding to this particular period, I discount it with the interest rate corresponding to the previous period. So this is the way we try to identify the cash flows that are associated with the bond and then discount by each of the periods. Okay, if I say the cash flows are corresponding to this period, then I discount them first to this period, then discount them to this period. So if I am discounting them to this period, I'll use the cash flows of this period and the interest rates of this period and discount them. If I want to discount to this period, I take the cash flows of this period, 1 period ahead, and then discount them by the interest rate of the previous period. So this particular process where I am starting with the last period's cash flows, working backwards node by node and determining the present value of that particular security is what we call as backward induction methodology. The process of finding out the present value in a binomial tree model where we are taking the cash flows of the last period, working out node by node, coming back to the present value, discounting based on the interest rates of the previous periods is what is the backward induction methodology of finding the value of the bond or the underlying security. So in general, the building of this tree is a very complicated, tedious process. So the simple way is, one of the mechanisms that is typically used is an arbitrage free valuation procedure. One of the key mechanisms that is used in this process is an arbitrage free valuation procedure, especially for all the on the run issues. What does that mean? If I am taking all the on the run issues and trying to find the value on the run treasury securities, if I take all the on the run treasury securities and find their values using this binomial tree model, using the interest rates at each of the nodes of the binomial tree model, they should be equal to the current market price. Or probably putting it the other way, I get these interest rates at each of the periods by trying to equate the binomial tree derived price, binomial tree formula derived price for that on the run security to the market price. At what interest rate the binomial tree derived price will be same as the market price. So the interest rates, the probabilities, all these unknowns are obtained based on this arbitrage free valuation model. So by considering the appropriate on the run treasury securities, we generate this interest rate tree. It's a very general, it's a very tedious kind of a process. So generally we use computer programs and softwares to develop these kind of interest rate trees, but for our understanding purpose, we should be comfortable on how this is generated by considering the various on the run securities and making sure that when I do the valuation of these on the run securities, there is no scope for arbitrage. So at what interest rate the arbitrage opportunity does not exist at all will become the interest rate at each of the notes that are possible. That is a typical way of constructing a interest rate tree. Now what I really see is, I would like to look at one example getting into the valuation of a bond. First, probably to start with an option free bond, then we'll try to add a call option and a put option to a bond, find out the value of that call option, right, valuing a bond. So first I'll look at an option free bond valuation, then I'll try to bring in a call option as well as put option into that bond, and see how do we value the bond that is containing the option, and from there how do I compute the option values. So that is what we will try to take using the example. Now whenever we talk about an option free bond or whatever it is, first initially we need to build an interest rate tree, right? We have to build an interest rate tree. So for that interest rate tree, probably as I said, it's a complicated process, so we'll take an example where the interest rate tree is available, and based on that we'll try to get into the valuation of a option free kind of a bond. Okay, so let me look at these numbers. So I am assuming that the current 1 year rate, interest rate is 7%, and after 1 year I am assuming that the 1 year rate can be either 7.8% or 7.2% with equal probability. So there is a 50% chance that the interest rate, 1 year rate, may be either 7.8%, and there is a 50% chance that the 1 year rate will be 7.2% after 1 year. And after 2 years I am thinking that if it has been at 7.8 after 1 year, I am expecting that it can go either to 8.1 with a 50% chance and 7.85 with another 50% chance. However, if the interest rate has reached 7.2 at the end of 1 year, I am assuming that it can reach either 7.85 or 7.4 with more or less equal probability. So that is what I am thinking of initially as my interest rate tree. So using this tree, I am looking at what should be the price of 7.5% annual coupon bond whose face value, let's say, is $1,000. So if this is the way the interest rates are expected over the 2 years, some interest rate bond, 7.5 coupon, annual coupon kind of a bond with a 3 years to maturity, what should be the value of the bond? A 3 years to maturity, which means at the end of 3 years, let me assume that this is 0 years, 1, 2 and 3. At the end of 3 years, I will definitely get my face value, which is 1000, whatever may be the interest rate at that point, because the cash flows of 1000 are coming up in each of the years, right? As a part of the bond, I will definitely get 75 at the end of first year, 75 at the end of second, and 1075 at the end of third year. These are the cash flows that are going to come up, right? Now I would like to find out the present value of each of these things. So basically here instead of 1000, let me write it as 1075. So I will get 1075 at the end of third year. Now what is that we are saying? At the end of third year we will get 1075 even if the interest rate is 8.1 or 7.85 or 7.4. But if I want to find out the present value of this to the second period, I will discount these to the present value by using this rate or by using this rate or by using this rate. So if at all the interest rate was 8.1%, 1 year rate was 8.1% at the end of the second year. So what would be the present value at the end of second year? It would have been this divided by 1 plus this. Okay, so 994 would have become the present value of this future 1075 that I am going to get at the end of third year. Similarly, if at all at the end of 2 years the interest rate had been 7.85, then the present value would have been 1075 divided by 7.85%, which would take it to 996, and the same logic applied to 7.4% will take the value of the bond to around 1000.93. fair enough. Now again there is a 50% chance. Now okay, these are the possible present values. If at all it touches 8.1 if at all the interest rate is 8.1, the present value is 994, otherwise 996, otherwise 1000.93. Now what we are saying is, I'll work backwards. If I want to know at this point, because 8.1 is possible only if it was 7.8 in the interest rate was 7.8 in the previous period. That is what, and 7.85 is possible under both the conditions. Either it could have been 7.8 or 7.2 with equal probabilities. So the better way to work out here always is, if at all I want to find out the present value here, I will take 50% chance of going up. So if at all it is going to 8.1, the value of the bond is going to be 994 at that time. So there is a 50% chance that, see, if at all we are talking about a 994 or 996 with equal probability. So I will try to find out what is the expected value. So the expected value is nothing but the average of these two things. So when I say that, so there is a 50% chance of 994 being the value, especially if the interest rate at the end of second year touches 8.1, or it could very well be 996. So the average of these two things is the expected value. The same way for this, the expected value is going to be the average based on this number as well as this number. Okay, so 998 happens to be the average. So if I take the present value here, this is after 2 years. But if I want to find out the present value at 1 year, I can discount this by 1 plus whatever is the interest rate. So this node, I work node by node. That is what we call as a backward induction kind of a methodology. The same way here. Okay, here along with this, there is a 75 that is coming out as a cash flow in the year 2, right? Because that is also coming out in the year 2. I am adding another 75 to it. Okay, 75 is a cash flow that is coming out in year 2. So the value of it is becoming 998 here. And the same logic I can apply again, saying this particular value I discount it by 1 plus 7.2%, but at the same time add a 75 to it. So this is the value that it is going to be at the end of 1 year. Now, right now, so if there is a 50% chance for this and a 50% chance for this. So again, the expected value is nothing but the average of this comma this value. So this is the expected value. So if at all I want to find out the value here, again there is a 50% chance of getting this value plus another 50%. So that is already worked out, which is equal to this number. So I will discount this by the current interest rate, which is the 7%, and at the same time in the second year I am going to get even another 75 there. So even that 75 is also added up. So basically here even that 75 also need to be discounted to the present value. So let me do one thing. Instead of adding a 75 separately, I will add 75 here itself. Instead of adding 75 separately, I will add 75 here itself. Right? Because this is at the end of the second year, I am going to get that 75. So this is going to be this is going to be the average, and here also let me add up 75 here only. Alright. So this bond is going to cost me 1002.26, because there is a possibility that whatever the interest rates are, this bond is going to give me, I mean right now the interest rates are only 7 and 7.2, but the coupon is around 7.5%. So because of that reason, I am seeing that the value of the bond, if at all there is no option or anything else also, it is going to be 1002.26. So which means it could be a premium kind of a bond itself, especially for the next 3 years. If the bond is going to pay me at the rate of 7.5% every period, 7.5% coupon every period, it is appearing like this is being sold at a premium itself. Now let me try to pull in, if at all this particular bond is having a call option on it. Right, I will make a small improvement here. If at all this bond has a call option, which is European, with a 2-year maturity, for a strike rate of 7.5%. So I am putting the strike rate is 7.5%. So what should be the value of that bond? So earlier it was no option kind of feature on the top of it. It's an option free bond, which came out that the value of it is 1002.26. But now if I think of a call option present on it, a European call option on the bond for a 2-year maturity period, the option is available for a period of 2 years with a strike rate of 7.5%. So because it's a call option, and that too we are talking about the 2 years to maturity and European. So the exercise of this bond can happen only at this particular point, and because this is a callable bond, a call option, only if the market price is higher than only if the market price is higher than the strike price, then only we are going to exercise that particular bond, right? Because it's a call option. Call option, only if the market price is higher than the exercise price, then only I am going to exercise the bond, which means in this case, when the interest rate was 8.1%, I will not exercise the bond. I will not exercise the call option because the bond price. So wherever the bond price is greater than the market price, then it will be the same as the strike price itself, because we are talking about okay, I will not talk in terms of the strike rate. Probably I will say that the price is going to be 1000. The strike price only I will talk of initially. A strike price of 1000. When I am talking about a strike price of 1000, obviously wherever the market price is greater than the strike price, we will purchase the bond at the strike price itself. Otherwise we will go with the market price only. So what I will do is I will check out if this is greater than 1000, I will take 1000, otherwise I will take this value only. So this is the same thing I will repeat for all the 3 nodes. So at the third node, instead of 1000.93, I am getting it as 1000 itself, because the price of the bond, if the interest rate comes to 7.4, it is going to be 1000.93, which becomes the bond is the market price of the bond will be greater than the strike price. So because I have got into a call option on the bond, I can purchase the bond at 1000 itself. Now using that logic, I can find out the expected values now. Here in this case, the expected value is 995.6 only, whereas here there is a small change. Instead of 998.84, it becomes 998.37. Right? It becomes 998.37. And when it comes here, I am finding out the present values of these two along with the $7 or $75 that is coming in the form of the coupon. So probably I will use the same formulas which have been used here. The same formula here is going to give me, this is going to be 1070. J1323 plus 75 divided. Okay, here let me freeze, instead of C1323, let me freeze this. Okay, this is going to be 993, and the same thing if I am doing it here, this is going to be around 1021. A small difference, 101.28, here it is 101.72. Now the same logic when I am taking it from here to here also, what is coming out is, okay, first I need to compute the value here, right, which is the expected value of the two, and even here also I'll discount it by 7% to get it to 1002.06. So the callable bond with this kind of a feature will be available for 1002.06. An option free bond is available for 1002.27 for this kind of features, whereas a callable bond is available for 1002.06. So the difference between these two, which is 0.21, we say is the value of the call option on this particular bond. Value of the call option on this particular bond is going to be that much. So the straightforward way of working out. So if at all I am talking about what is the value of the call option, the other way of looking at it. What is the value of the call option? Now I will look at it only from a payoff standpoint. What I will say, if from a payoff of a call option perspective, if I have to look at it, if this value is greater than 1000, I take it as this value minus 1000, that is the payoff. Otherwise, I will take it as 0. That is the payoff for me. So in this case, the payoff is 0. In this case, the payoff is 0. Whereas in this case, the payoff is somewhere around 0.93. Then I am taking the 50% of this plus the 50% of this to find out the expected value. So this is what is the expected. The same thing I am applying it here, saying this is the expected value. Now this is what I take the present value to the previous period. So this value divided by 1 plus this value will become the present value to the previous period. The same logic will come here also. Now again, based on this, I have an expected value 50% of this plus 50% of this, making it 0.21. Again I can take it to the present value 1 plus this. So this 0.20 should be matching with the difference between these two numbers. Let's see whether it is exactly matching. This minus this is exactly equivalent to this. So this is the value of call option, whereas this is the value of callable bond, and this is the value of option free bond. These are the three things. So from here we can very well derive the relation that the value of callable bond is equal to value of option free bond minus the value of call option, or the other way. If I want to know the value of the call option, I can take the value of option free bond and subtract the value of the callable bond from it. So this is how we work out with the call option on the bond. The same way I can do a put option. Now if it is a put option, right, if I want to look at a puttable bond, look at wherever the market price is lesser than 1000, make it as 1000. Okay, if this value is less than 1000, this is the value of a puttable bond. Make it 1000, because a put option will be exercised only if the market price is less than the strike price. Right? Strike price is 1000 for us here. So wherever the market price, which is nothing but the present value of discounted at the particular interest rate. So if that value is less than 1000, make it as 1000, otherwise retain the value itself. That is what goes as a part of the put option scenario. So I'll take, these are the values of the bond at each of the nodes. Now again, I take the expected value, which is 50% of the above value versus 50% of the below value. So here 1000 only, whereas in the second case it is 50% of this plus 50% of this, taking the expected value to be something like this. I take the present value, which is this, divided by whatever the interest rate at the end of one period. So this is, and even I need to add 75 because it's a coupon bond. Okay, I'll add 75 more to it. So this is the present value there, and at the same time I can do this exercise here, this plus 75. I'm discounting these, divided by 1 plus the 7%, probably 7.2%. So this is coming out to 1003. Again the same logic, I am using 50% of this plus 50% of this, so giving this as my expected value, and the same logic again. So this plus 75 divided by 1 plus 7%. So this is giving me around 1004 should be the value of puttable bond. So this I call as value of puttable bond. And now when I have to look at only the value of put option, all I should look at from the original data set is wherever the value, market value is lesser than the strike rate, the payoff is the strike rate minus the value of the option free bond. So here I will put a comparison saying if this is less than 1000, I'll take it as 1000 minus this number, otherwise I'll take it as 0. The payoff is taken as 0 in other case. So I'll take this scenario in each of the cases. So at least in the third one, because the value is 1000.93, the put option will expire, which means the payoff is going to be 0. And here I can try to find out the expected payoff. So I'll try to say 0.5 times this plus 0.5 times this, so 4.39. The same thing if I take it here, it is 1.62. I can do the present value of this. So I take the present value of this bond and discount it with the 7.8%, right? And similarly the same, I take the present value of this and discount it by 7.2%. So obviously based on these two I get an expected value which is 0.5 times 4.07 plus 0.5 times 1.51. Again I can take the present value of this call option by discounting it at the rate of 7%. So this is the value of the put option. Now if I subtract the value of the puttable bond or value of the option free bond from the puttable bond, I should get the value of the put option. So value of the puttable bond is equal to value of option free bond plus the value of put option. So this is one more dimension that we need to be comfortable with. So just to talk about two important formulas, value of callable bond is equal to value of option free bond minus value of call option, whereas value of a puttable bond is equal to value of option free bond plus the value of the put option. So this is what we should understand, because any kind of numerical that we may have to work out, or any kind of practical issue that we may have to work out, it has to be looked from this specific dimension, right? So starting with an option free bond, we should look at how do we get into the valuation of a bond with an embedded option in it, whether it is a call option or a put option like this. So we should be able to value the bond, as well as we should know how the value of that particular option is computed even without knowing the value of the bond. So based on the payoffs you can find out the value of the option, whereas when we are looking at callable bond or puttable bond, we are looking at comparing the strike price with the market price, and based on that assessing the value of that particular bond. Alright, now we will look at one more aspect on this dimension, which is something to do with the spread. We'll look at the concept of spread. How do I incorporate the spread as a part of these models, and how do I value the bond using the spread as a concept. Alright. So whenever we talk about spread in this context, we use three types of spreads. One is a nominal spread, one is a zero volatility spread, or called as Z spread in short, and one is option adjusted spread. The way we talk about the spread is nothing but the difference between the yield of our bond minus the yield of the benchmark security, which could be, let's say for time being, let me consider a treasury security as a benchmark security. Now just to understand, let's say my treasury rates, right, let's say my treasury yield to maturity is somewhere around 6%. The treasury yield to maturity, let me assume that it is around 6% for the same example, right? So what I have to do is to find out what is the nominal spread in this case, and let me assume for the example purpose, this option free bond I am purchasing at 1002.27 only. Right, I am purchasing this at 1002.27 and it is paying me 75 as the cash flows for the first 2 years, and 1075 is the cash flow at the end of the third year. So this is what are the returns that are typically given by this particular bond over a period. So if I am looking at finding the yield to maturity of my current bond, so I can very well find out the yield to maturity of this bond, because now I know the cash flows are, the initial year there is a cash outflow of this much, and after that 75 and 1075. So my yield to maturity is nothing but the IRR associated with this bond. So I compute the IRR for this bond and it is giving me around 7.41%. For the same bond, the yield to maturity is 7.41%, whereas the comparable risk-free security is having 6% yield to maturity. So obviously I can say that nominal spread for me in this example is 1.41%, whatever is the difference, right? If I say nominal spread, the difference is 7.4% minus 6%, taking it to around 1.41%, and that is what is the nominal spread. So whenever we talk about the nominal spread, we are talking about the difference between the yield to maturities of a zero coupon, risk-free kind of a bond and the bond in question directly at a yield to maturity layer. But the next thing when I look at, it's the zero volatility spread, that is the Z spread. For that Z spread, I typically look at not the yield to maturity, I look at the spot rates for each of the 3 years. I look at the spot rates for each of the 3 years and then discount the cash flows corresponding to that spot rate, and based on that we'll see what is the zero volatility spread, that is. So I don't look at the YTM here. Probably I may focus more on for time being, let me take 6% only is the spot rate for all the periods. See, just to demonstrate it, the spot rate for all the 3 years, let me assume it as 6% only, the treasury spot rate. The treasury spot rate for all the 3 years, let me assume it as 6% only. If that is the case, so my cash flows will become 75 by 1 plus 6% plus some particular spread. Similarly, 75 by 1 plus 6% plus the same spread squared, and 1075 divided by 1 plus 6% plus the same spread cube. This should be equal to my present value, or which is the price. So this is what we typically look at when we go with an option, when we go with a zero volatility kind of a spread. So let me assume that for this bond itself, if at all this percentage, the spot rate is same for each of the years, which means the yield curve is flat, then there is not much of a difference between a zero volatility spread and a nominal spread. But when I see that there is when I see that this is not the rate, probably it is 5.5% here, 6% here, and 6.5% here. That is where I see that the zero volatility spread may be different from a nominal spread. So for this bond itself, so if I assume that these are the spot rates for the 3 years, 5.5%, 6% and 6.5%. So in that case, what would have happened to my cash flows? So it would have happened, let's say that my purchase price is still 1002.26 itself, whereas the cash flows that I am going to get are going to be 75, 75 and 1075. Now in that case, what I'll do is I'll assume that this is the spread. I'll assume that this is the spread. Probably let me take this particular value as the spread. Now all I'll try to do is I'll discount this by 1 plus 5.5% plus this spread. This is the present value of this 75. Then I will discount this by 1 plus 6% plus this particular spread whole squared. Then this 1075, I'll discount it by 1 plus 6.5% plus this particular spread whole cube. So this is the present values, and probably I'll add them up to arrive at a value of 1027. But this value should be equal to 1002 only. So probably I'll say, okay, if this is 1%, what is the case? Yeah, this is coming out to almost 1001.26, which is slightly on the higher side or on the lower side compared to the market price. So slightly reduce it. If I say 0.9%, it is still on the high. This has gone up. So probably make it 0.95%, almost approaching. So I'll try to work out like this, 0.96%. Yeah, it has come very much close. So what I say is the spread in this case is going to be somewhere around 0.962% or something like that. So 0.962%. Yeah, 1002.25, something like this, wherein the market price is matching up with this calculated price. So I say the spread in this case is 0.962%. That is, so whatever is the spread, I am adding to the spot trades, to each of the spot trades, to arrive at the bond price is what we are calling as a zero volatility kind of spread. And the interesting aspect here is the third one, which is an option volatility kind of a spread. When I have to look at the option volatility spread, I am looking at our option adjusted spread. I am trying to add that spread to each of these locations. So instead of considering, probably if I have to make some kind of improvisation here, instead of considering 7% directly here, probably if I take it as 5%, I'll just if I say the spot trades, right, the spot rate in this case, if I assume that the spot trades in this case are like this, based on an interest rate tree, right? So the value of the bond actually is 1002.26. So I'll take a small example. This particular bond, whichever is, so let me make a small modification to this exercise. I assume that this is a treasury security. Assume that this is a treasury security, and for this treasury security, these are the projected interest rates for the next few years. So the option free bond of a treasury security was being sold at 1002.26 as per this model. Now if I assume that the bond of my interest is being sold for 1005, or probably because there is a callable option here, now we have to look at it as the option adjusted spread. So if I say, okay, for this particular bond, the price is going to be 995. This particular bond is available at 995 only. Then what should be the adjustment? What should be the spread? So what I will do to do that is, each of these cases, for each of the node, I will add a spread value. Right? Let me add one spread value. Let's say this is the spread. For each of the nodes, I will add up this spread value. So when I am doing this, adding of the spread at each of the node, that is where I am trying to look at an option adjusted spread. Okay, this is what is resulting in This is what is resulting in a spread of okay, if this is the case, now what I am seeing is, now this value should be only 995 because my bond is being sold at 995 only. Now what we are saying is, okay, if I add 1% spread, okay, this is going up to 976. So if I add a 0.5% spread, yeah, it is coming out to 989. So 0.4% spread 991, 0.3% spread 994.48. So when I put a 0.25% spread almost, so 0.25, 0.26 kind of percentage is bringing me more and more closer. So I can very well say the spread, option adjusted spread in this case is somewhere around 0.26%, because I am seeing that when there is so I am making a kind of adjustment at each node of the projected interest rate tree model and trying to find out the value, equate the binomial tree price to the market price of that particular security. If I assume that this tree is purely a treasury interest rate tree, and my security is going to have some level of spread at each of the layers. So for each of the possibilities of the node, if I am adding up that particular spread and using it as a part of the computation of the value, we are calling it as an option adjusted kind of a spread. So these are the three spreads that are typically considered as a part of the bond valuation exercise, and we need to be comfortable with the mechanism of computation of all these three models of spread. The nominal is very easy to compute, whereas the zero volatility is slightly difficult to compute because we have to arrive at the spot rates from the bond rates, and then for each level of spot rate we are adding up the spread. And when it comes to option adjusted, for each node of the interest rate tree we are adding up the spread, and finally finding out the value of the spread. So for different cases we will be looking at different spread kind of mechanisms. So so once we have a good understanding about this, until here we can progress further remaining aspects of the bond valuation with the embedded bonds, embedded options in it. All right. And just as a couple of small points to understand, especially when I look at the volatility of the interest rate. If the volatility of the interest rates is higher, what we see generally, the call option, any volatility scenario, the call option premium will increase or the call option price will increase. So obviously the value of a callable bond will decrease, because value of the callable bond is nothing but value of the non-callable bond minus the value of the call option. So obviously, because the value of the call option is going to increase with respect to the volatility, because we know that any kind of call option or a put option, any option on a security, if the volatility of the underlying is increasing, the value of the call option as well as put option is going to increase. So from that dimension, when we look at a value of the puttable bond, it will increase because the value of the puttable bond is value of the non-option free bond, right? I don't say non-callable or non-puttable, option free bond plus the value of the put option. So because the value of the put option is going to go up with respect to this volatility, we are seeing that the value, so the higher is the volatility of the interest rates, we can think of the value of the callable bond coming down drastically, whereas the value of the puttable bond will keep increasing. So just as a summary, whenever we are looking at option adjusted spread being positive, whenever we see that the option adjusted spread is positive, all I have to see is the actual OAS, anytime actual OAS, is it less than whatever is the required OAS. If the actual OAS is less than the required OAS, we'll say overvalued, otherwise we can go with undervalued. But when the option adjusted spread is negative in itself, in all cases we can directly say overvalued. I don't need to do this kind of comparison at all. Whenever I see that the option adjusted spread is negative, I don't need to bother at all with respect to the valuation. I can directly say that it is overvalued. But wherever I see that the option adjusted spread is greater than 0 or is it positive, we are looking at comparison of the actual option adjusted spread with respect to the required option adjusted spread, and if it is lesser, probably we call it as overvalued, and if it is high, we call it as undervalued. The next important concept that needs to be looked at concept to look at in this context is the mechanism of the effective duration and effective convexity, especially for a callable or a puttable bond. So in the regular scenario, we know what is the way we compute the duration and the convexity, especially when there are no options on the bond. So the typical way we define the effective duration is what is the bond value in case there has been a negative shock minus or difference in the bond values, percentage change or the absolute change in the bond values in case there is a delta shock to the decrease as well as increase, divided by twice the bond value, initial bond value times the delta y. This is nothing but percentage change in the price of the bond. The value of the bond when there was an increase minus the value of the bond when there is a value of the bond when interest rates decrease minus value of the bond when interest rate increase to the original value of the bond multiplied by whatever is the change in the interest rate, because we have changed by delta y towards the downside as well as the upside. This is nothing but this portion is the percentage change in the value of the bond, and this portion is the percentage change in the interest rate. So this was our definition of effective duration. And when it comes to effective convexity also, we said the value of the bond when there was a drop in the interest rate plus value of the bond when there was an increase in the interest rates minus twice the initial value of the bond divided by 2 into initial value of the bond into delta y squared. This was the mechanism to compute the effective convexity. Now, if at all our particular bond is having embedded options on it, the same logic. Initially, you start with option free bond. For the option free bond, you first compute what is your effective duration and effective convexity. Doesn't matter. Now, you know your interest rate tree, because we are talking about a callable bond or a puttable bond. Take the interest rate tree, and based on that interest rate tree, first compute the option adjusted spread associated with the bond. We have seen across the interest rate tree, if I am adding one particular spread, and trying to find out that spread. That spread I am calling as option adjusted spread. So based on the interest rate tree which we are going ahead with, you compute the option adjusted spread. Now give a small shock minus to the interest rates. You consider that the interest rates have either decreased or increased, because when I have to compute the duration, I am giving a shock to the interest rate. So make a new interest rate tree. Prepare a new interest rate tree based on the decrease and the increase in the interest rates. And that directly don't do it at the on the run treasury securities level. On the run treasury securities level, you either decrease or increase the interest rate, and based on that form the new interest rate tree, again using the arbitrage free valuation process. And using this new interest rate tree, add the OAS to each of the notes, and based on that find the value of the callable or the puttable bond. Find the value of the callable or a puttable bond, and whatever is the percentage change in value, or the same thing you will repeat for an increased shock, which will give you V minus as well as V plus. And once you know those values, rest all is the same. Use the same formulas of expected duration, effective duration and effective convexity to typically compute the effective duration of the callable bond as well as of the puttable bond. That is the way you have to get in. So the OAS plays an important role in determining the effective duration as well as effective convexity of a bond which has embedded options inside it. So that kind of a care needs to be taken if at all we are interested in finding out what is the interest rate risk that is involved with respect to callable as well as the puttable bonds, or any bond which has an option that is embedded into it. All right. In this session, we are primarily dealing with the concept of a convertible bond, which is primarily, initially I have a bond and I can exchange this bond for a few shares of a company. That is what I call as a convertible bond. Initially I purchase a bond itself, but at a later stage I can convert them into the shares of a company. And one bond to how many shares it can be converted at a later date, which is what we call as the conversion ratio, it is decided at the time of issuance of the bond itself. So sometimes people look at the concept of convertible bond more on the lines of an embedded call option on the bond. So more or less similar to an embedded call option on a bond, but of course we look at two key differences with respect to a callable bond, with respect to a convertible and a callable bond. The key differences which I notice in case of convertible versus callable bond: generally the right to exercise the option here is with the investor or the person who has purchased the bond. He can purchase the share. That is what is there as the convertible bond. Whereas when we are talking about a callable bond, the right to buy back the bonds lies with the issuer. So there is one key difference between these two worlds, and when I am looking at a convertible bond, the conversion happens with respect to the bond. The bond is exchanged and the shares are taken. Whereas here the purchase generally happens with cash, where based on the exercise price. So these are the two key things that we look at as the differences that are existing between a convertible bond and a callable bond. But otherwise, the base mechanism, the base calculations, or the base concept, they remain the same. So, how many shares would be given per each bond on that conversion date, which is known as a conversion ratio, which would be known to the investor right at the beginning itself. And whenever I am looking at the conversion price, we are simply talking about whatever is the price of the issue, whatever is the price of the issue divided by the conversion ratio. So if I am saying I am giving for one bond, there are 10 shares that are given. So the conversion ratio is 10. And when I am talking about the conversion price, I am looking at the issue price dividing it by 10, saying that this is the conversion price associated with this convertible bond. And when I take this conversion ratio and multiply it by the market price per share, I get the conversion value. Because every convertible bond, we see that when it converts into a share, depending on the now, because one bond is converted into 10 shares, when I want to know what is the conversion value as of today, I take the market price at which I'm going to convert the bond into a share, multiplied by the conversion ratio. That will talk about the conversion value of the particular bond. And in this context, I also need to understand the straight value of the bond. Okay, here we have to understand a conversion value versus a straight value. If the bond is continuing as a bond itself, because here the investor has an option to convert it into a share or not. So if at all he is not converting it into a share, if the bond is continuing as a bond, what is the value of it? Which means it's like any other plain bond where we talk about the present value of the future cash flows. So assuming that the bond is not getting converted, we are trying to find out the value of the bond, which is called as a straight value, as if the bond is not having any convertibility feature, non-convertible bond. Try to find the value of a non-convertible bond with the same set of features. We call that as a straight value for the bond. And so based on that, we try to find out the minimum convertible price or minimum value of a convertible bond. It should be at least greater than it should be the maximum of either the straight value or the conversion value. That should be the minimum tradable price for a convertible bond. The trading price should be greater than, or should be definitely greater than either of these things. So, I mean, that is the one way to judge what should be the minimum market price for this convertible bond. It should be either, it should be greater than either of its, the maximum of either the straight value, which means assuming that it is not converted, or conversion value, assuming that it is converted. So just to understand with the same example, let's say I can, as per the convertibility feature, if I say one bond can be converted into 10 shares, and when I try to find out the present value of the future cash flows of this bond, let's say it is coming out to $92, and let's say the current share price is $8.5 per share. So what is coming out, even if it is converted into 10 shares, the value is $85. So this value is the conversion value, and this value is the straight value. If at all the bond is not converted, the value of it is 92. If at all the bond is converted as per the current share price, the convertible value is 85. So what we are saying is this convertible bond minimum value at which it should be trading is $92. This is how we can understand the minimum value of the sale price for a convertible bond. Then we are trying to understand, if at all, if I have to look at the market conversion price, it is nothing but it's the effective price if the bond is purchased and immediately converted into shares. Otherwise typically called as the conversion parity price. Why do I call like that? I am purchasing the bond and immediately converting into shares. So what is coming out? The market price of the convertible bond divided by the conversion ratio is what is. So the market price, if at all, currently the market price, let's say, is $95 for this bond, because it has to be minimum at 92. Assuming that the current market price for the convertible bond is 95 and the conversion ratio is 10. So what we are saying is $9.5 is the market conversion price for the bond. So market price, the current market price of the convertible bond, which will definitely be greater than the maximum of the straight value versus the conversion value. So the market conversion premium is whatever is the market conversion price minus the current market price. So whatever we are taking as market conversion premium. So currently the share price is only $8.5, but the market conversion price is $9.5 per share, right? Because I'm looking at the current market price of the convertible market conversion price coming out to $9.5 because I have considered the market price of the convertible bond divided by the conversion ratio, whereas the current share price is only 85, which may 8.5. So 9.5 per share minus 8.5 per share, which is $1 per share, is what we call as market conversion premium, because the market conversion value is currently $1 more than the current share price. So this much of premium today the investor is willing to pay under the assumption that the stock price will rise and he can be in a position to convert the bond into a share in the future. Now, even if the stock price falls, he can continue it as a bond, but if he is paying a premium here, the key understanding is the investor is quite confident that the share price is going to go up in future and he can very well convert, right? This can be expressed even in a percentage form. $1 per share is the premium out of a current market price of $8.5 per share. So it can be established even in a percentage form. So the market conversion premium, otherwise I call it as ratio. market conversion premium ratio is nothing but whatever is the premium, which is $1 per share here, out of the current share price, which is $8.5 per share. Whatever is the percentage, that is the premium over the current share price the convertible bond is currently trading at. Here, the interesting part to understand is the premium payback period. See, what we generally see is with respect to the convertible bonds, the coupon will generally be greater than the dividend. If at all, see, there are two options for me at the beginning. I can buy a convertible bond or I can buy a share. Right? I can buy a convertible bond which gets converted into a share later, or I can buy a share right now itself. Now, in general, what has been observed or what should be the lucrative factor for this is initial periods the coupon will be much higher compared to the dividend which I get on the share. So, instead of buying the share directly, probably there is a possibility of buying the convertible bond. So, that premium, whatever has been coming out, that $1 premium, that is going to offset over a period, which will result in that increase in the premium that has come out, because over the periods the coupon is greater than the dividend which is coming up on the share, and gradually over the period that excess, that is what is translating into a premium which people are willing to pay for that convertible bond compared to a direct purchase of a share. So from that dimension, what we are saying is, if at all I want to know what is the premium payback period, I'll take the market conversion premium, which in our example was $9.5, divided by the favorable income difference between the shares. This is an important one. What we typically look at as the premium payback period is nothing but market conversion premium per share divided by the favorable income difference per share. So the way I look at the favorable income difference is look at the coupon interest, by what extent coupon is greater than the dividend. So coupon, whatever is coming out, minus the conversion ratio, whatever the number of shares you would have got, multiplied by dividend per share. This is the excess, and this excess you divide it by the conversion ratio to get the favorable income difference per share. So when I divide it by the favorable income difference per share, so on every period that is the excess that I am getting per share, right? That is the excess that I am getting per share. So that excess in how many years that excess is going to neutralize off the premium that I am typically paying. So in any case, let's say for this example, when I said that 92 is the current price, I need to understand what is the coupon from that particular bond and what is the dividend. And when I find out the coupon minus the conversion ratio times the dividend, let's say currently I'm getting a coupon of $10. Whereas because I'm able to convert that into 10 shares, one bond into 10 shares, and each share is going to give me a $0.5 dividend. So obviously the numerator is going to be 10 minus 5 divided by 10. So 0.5 is coming out as the premium, 0.5 is coming out as the favorable income difference. So now when I take 1 which is 9.5 which is the sorry I need to take the minimum convert the premium. So the premium whatever was the case market conversion premium which was not 9.5 sorry we had $1 1 divided by zero point 0.5 which is 2 in 2 years that is getting nullified. And one more thing is the downside risk with respect to a convertible bond is nothing but what is the premium above the straight value. So we have looked at the straight value of the bond is 92. In our example, the straight value of the bond is 92 and the premium is 95. So all I am talking about is premium above the straight value. So 95 minus 92 divided by 92 and probably minus 1 if I am taking, that is what is the premium over the market price. That is a measure of the downside risk associated with the convertible bond. So the higher is the downside risk, the convertible bond becomes less and less attractive and vice versa. So whenever we are trying to go ahead with a convertible kind of a bond, first look at an option free bond and look at similarity with respect to a call option wherein the amount and take a call option on the top of that. So we are talking about value of a convertible bond is nothing but the straight value plus the value of the call option, because this is the benefit that is being given to the investor, not the issuer. What we are saying is value of the convertible bond is equal to value of option free bond plus value of the call option. This is so probably the value of the call option again you can try finding out using a Black-Scholes kind of a formula itself. So the other way you should look at is if at all the bond is having both callability as well as convertibility, then I am looking at value of option free bond plus the value of call option on the stock for a convertible bond minus the value of the call option on the bond, which is what is the value of a callable and convertible kind of a bond. So all these things we need to be comfortable with. And one more thing is, okay, as the volatility of the option is of the volatility of the stock price is increasing, the call on stock will increase and the callable convertible bond is going to increase in value. So whichever. So the call option, remember it that this is a call option on the stock. In a convertible bond, the call option is on the stock, whereas in a callable bond, the call option is on the bond. And the callable bond will the call option will reduce the value of the callable bond, but it will increase the value of the convertible bond. So all these small things need to be remembered for the computation purposes. So some of the things that we need to look at, why do we really look at investing in a callable bond is there is some hope that in the future the stock price is going to appreciate, and I want to take an advantage of that stock price appreciation. See, when I buy a convertible bond, the downside risk is limited. If the stock price falls in value, I really do not need to lose much because I can continue with the bond. I don't need to face the loss because of a fall in the stock price. The bond will still continue with the features associated with the bond, which means my downside risk is completely limited because there is a floor price that is set by the straight bond. So anything below that I am currently protected of. So if there is an increase in price, yes, I am going to take an advantage out of it. But any kind of fall in price, I am shielded from the downside because I can continue as a bond. So from that dimension, people look at going ahead with a convertible bond instead of investing directly in the stocks, right? I hope these things came comfortable to you, understanding the convertible bond as well as valuing bonds with embedded options in them, valuing a callable bond, puttable bond, finding the option adjusted spread and zero volatility spread, nominal spread, differentiating between the various forms of spreads, and finding out the effective duration and convexity of a bond which has options in it. So all these things will clarify your understanding of valuing a bond which contains some kind of options in it. If you have any further queries regarding the same, you can get back to me by giving me a call on the number that I have provided below, or you can even send in an email at vamsidhar@facegurus.com. Thanks a lot for listening to this session. Thank you very much.